Here we are working on exam 5, problem 2. On this particular exam, it's a bond problem. Army buys a 30-year bond at face value for $50,000, so they pay $50 for a $50,000 bond. Bonds pay 6%, June 30, December 31. Company intends to hold the bonds to maturity, record the journal entry for the purchase of the bonds, and the receipt of the first 6 months interest on June 30. Okay, so just 2 journal entries. That's easy enough. Date, accounts, debit, and credit. Alright, so the first thing is the purchase, which is on January 1. Right, and of course we get a held, let's go write HTM, held to maturity, debt investment, right, $50,000. And this is an asset. It's a bond we've purchased, held to maturity, debt investment. And of course, we had to pay for that. We paid for that with cash. And that's the purchase. Okay. The next thing is interest. So on June 30, pays interest on June 30. So 6, 30, 19. So that's 6 months of interest, right? All of January, February, March, April, May, and June. So 6 months worth of interest. So we're going to this time receive the cash, right? Because they're giving us the interest, and that's going to be interest revenue, right? We've earned it. How much? Well, interest is still just principal times rate times the time. So that's 50,000 times 0.06, because it's 6%, times half a year, 6/12, or 1/2, right? So that's equal to 1,500. So there's your 2 journal entries. We purchased a bond, and the name of that account is held to maturity debt investment. And of course, you pay for things with cash. Then we received interest in, so we got in the cash, 1,500, and that's the account interest revenue. And of course, we're using our interest formula, so that's equal to interest, right? 50,000 times 6% times half the year. Right, so that's how to work a bond problem. It could be you'll have to do the interest for December. It's exactly the same. That's the great thing about a bond is they pay the same amount of interest every time. Alright, well, next video we'll move on to problem 3.